Welcome, everybody, to episode 31 of Crossing the Line with Greg Heym. I haven't been replaced yet, so that's good. And I'm lucky, and you listeners and viewers out there are lucky, that we have a very special guest today, my good buddy Michael Vargas, principal and co-founder of Vanderbilt Appraisal.
Hello.
A guy who is considered the best appraiser out there. Just ask him, he'll tell you that.
The greatest of all time.
The GOAT. So how you doing today? It's hot out there, Vargas.
It's hot out there. We're doing this right after a 5-day July 4th holiday.
How awesome was that?
So I'm feeling good. I'm a little sore from tennis, pickleball, swimming, hot dog eating, but I'm ready to roll.
Now, the hot dog eating contest was a little bit disappointing without Joey Chestnut, who apparently ate more hot dogs than the guy who won in half the time, just to prove he's still like the GOAT. It's always fun to watch, but the best part of the whole thing is the intros. You know, they have like Badland Booker out there rapping, and
absolutely,
you see him drink the gallon of lemonade, and like, oh my, that's crazy stuff. But anyhow, today's July 8th. And as always, we're coming to you from beautiful Studio 1873, decorated by our friends at the Everset.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
So, as always, we're trying to be informative, concise, entertaining, edgy all at the same time. But I do have to I got some good news right before I got in the studio. Congratulations to my son for passing both his advanced placement exams.
Awesome.
Way to save daddy that college tuition money. Joanne, we're going on vacation now because that's a couple of credits we don't have to pay for. But great job, Gregory. I won't even make fun of your mullet on the podcast because you passed your test, so that's very good. So we have basically one item that was in the blog, and that was the jobs report. And, you know, you look at it, 206,000 jobs added last month, a little better than expectations. And you go, all right, another, better than expected jobs report. But those of you that are watching us regularly and reading the blog regularly know that last month when the number was 272, I didn't buy it, and we pointed out all the reasons why we thought they would be lower. They would go lower once revised. But let's go to the facts of this report and then kind of see where the disconnect really sticks out. So again, a little bit better than expected, 206,000 jobs. That sounds great. The unemployment rate ticked up from 4% to 4.1%. The economists out there that make these projections expected no change. That's a little worse than expected, but that doesn't sound so bad, right? 4.1 is still pretty low. Wages up 0.3% in June and 3.9% higher than a year ago, both in line with estimates. And that's cooling. We were seeing much higher numbers over the last couple of years, but that's good for inflation. Here's where, the first crack in this report. Government employment jumped by 70,000 last month. So basically a third of this growth is due to the government hiring. So that's concerning to begin with. And, we talked about the two surveys. We have the payroll survey, which gives us most of this data except the unemployment rate, and the household survey, which gives us the unemployment rate. The household survey also differentiates between part-time jobs and full-time jobs, and all of the job gain last month was in part-time jobs. Again, two possibilities there. Companies unsure about the future, don't want to bring on full-time workers, pay a lot of benefits, that kind of stuff, and people getting second jobs, which we talked about last month. Those numbers are going up. This was the concerning part, though. There were revisions always to the prior 2 months. So job growth for April was revised down by 57,000 jobs, and in May, 54,000 jobs. So a total of 111,000 jobs were taken away from job growth. And again, we were worried about this last month because of the data in the household survey. In May, there was a huge decline in employment in the household survey, yet the payroll survey showed 272,000 growth, which is now just 218,000. I know a lot of you might say, well, that's still pretty good, right?
That is pretty good. That's still pretty good.
But not as good as 272,000. What you learn from this is never get too happy about economic data when it comes out, because most of it is always revised. These are taken in the middle of the month, these surveys, and a lot can happen in the last 2 weeks of a month. Remember, COVID took hold the last 2 weeks of March 2020, if I'm remembering correctly. But enough of all the gloating, although I do like to say I told you so. But let's kind of break down what this all means. Job growth is slowing. That's the big takeaway here. If all the hiring is part-time too, that kind of takes a lot of the excitement out of the headline number. But again, when pretty much a third of that job growth is from the government, that doesn't look so great. The big downward revisions, basically, if you want to throw that into the mix, you created less than 100,000 jobs last month. The unemployment rate is really low at 4.1%, but it's now risen each of the past 3 months to its highest level since November of 21. Wage growth is slowing. Again, that's good news for inflation. The median duration of unemployment, which is, the median's always looking at the middle, and duration of unemployment, how long people are unemployed till they find a job, reached 9.8 weeks in June. That's up from 8.8 weeks a year ago. So it's taking people longer to find jobs, and that's also showing up in continuing claims for unemployment, which have risen for 9 straight weeks. So all these tell us, labor's cooling a little bit, which should bring inflation down further. Inflation has been headed in the right direction with a little bit of a stuck in the mud couple of months. But look, Wall Street was ready to party, and they certainly did. They said, you know what, we're going to focus on the increase in the unemployment rate and the downward revisions to April and May, because maybe June will get revised downward. There's certainly a good chance of that. And that means we're going to get our Fed rate cuts soon. And they were partying. They were very happy. In fact, the chief economist at Goldman Sachs said on Friday, he expects a rate cut in September. And guess what? The futures markets agree with him. So now the odds of a 25 basis points, or as normal people call it, 0.25%, cut in September are now 77%. The stock market was really partying, and the S&P 500 and NASDAQ closed at record highs on Friday. So I still think it's too early to even be planning about rate cuts. The Fed seems to agree with me, because they're out there saying, don't plan anything yet. It's like my mother. When I have to take my mother out somewhere, or we want to go out to dinner, she's always like, don't ask me now. I won't know until right before we're supposed to go out. And, it's hard to plan like that. But, the Fed does try to telegraph what they can. So do you want to jump in on this, Michael? What do you think?
Yeah, I think it sounds like, a lot of this sounds like features of a soft landing, perhaps, that the Fed has been trying to steer us towards, avoiding a recession, avoiding a crash of the economy with after their series of rate increases. So I think that, those numbers seem to show that, the overall picture for the economy is not so hot that the Fed can't, think about perhaps their 2 rate cuts in the this year, or
right.
At least 1 rate cut this year. So I think you're since I listen to you all the time on this podcast, you're always talking about.
That's our promo for the show for next week.
It seems like getting inflation down and not crashing the economy, has been the bigger picture and the bigger goal here.
Something that the Fed's really never been able to do.
Right.
Like soft landings, they talk about it like it happens all the time. Yeah. It doesn't.
So if we had seen, for example, numbers that are different than what these are, if we had seen, 350,000 jobs and unemployment was at 3% instead of, ticking up to 4.1, then that would probably be an economy that's still too hot, and that there would still be fears that inflation is not going to continue down towards, tracking towards 3%, and that the Fed would not, have any incentive to cut rates in September or at any time this year. So it seems like these are the kind of, economic data points which are, kind of in the middle as far as performance, where you're looking for that soft landing. You're looking for an economy that's not showing that it's too hot, that the Fed can't, do the action that everybody's waiting for them to do.
It's funny. Well, it's funny, but it's almost like how you want to look at the economy. It seems like an appraisal, because what you're going to focus on, you look at the labor market, he goes, yeah, well, there's cracks in there that certainly things to worry about, but still 4.1% unemployment, 200,000 jobs added. That's not the problem. But remember, too, retail sales were down in May. And, the surprising thing was the Atlanta Fed has this GDP Now thing, and they were still expecting like 3% growth in the second quarter. But now their number for the second quarter has been revised down to 1.5%. So, it all depends on what you're focusing on and what you're looking at. And I think the Fed has to be careful. They when you screw up as bad as they did, they better get this right. And I think the concern is that we saw inflation flatten out. It was moving in the right direction. Then for a couple months, no movement at all. Plus, there are 8 million measures of inflation. We even have Rayflation now. There you go, Ray. You got one named after you.
On the jobs front, I think you mentioned 1/3 of the jobs were in government jobs. Yeah. Is that like all government jobs?
Yeah,
U.S. government,
all
local economy?
Correct.
Yeah. And I think that's been, it seems like that's been the case over, the last 6 or 12 months.
Private sector hiring has not been, when you strip out government,
right,
and when you look at the revisions, the downward revisions of so many of these monthly reports, job growth does not look as exciting. That said, if you're still adding jobs, we thought we were going to hit a recession. And by the way, there's still no guarantee a recession won't happen.
Right.
Economies always look pretty good right before recessions.
Yeah, I mean, I think when I hear those numbers and and you hear about them on the news or on CNBC, and they say, but jobs grew 200,000, but 70,000 of those were in government jobs. But a job is a job, right?
A job is a job.
Why does it matter?
Because government, just speaking for myself, but a lot of economists feel so way. Government is not as effective with their money. They're not as they don't get the bang for the buck that the private sector does, and government jobs can disappear. And so I mean, any job can disappear, but you want the private sector to do the hiring because they'll spend the money the most wisely. Because to pay for those 70,000 workers, they may have to tax the private sector.
Right.
So I think that's why you want.
There's a preference for private sector jobs over government, but
yes,
you want a good mix of, all factors that go into it.
Government employs a lot of people.
Yeah.
I mean, here in New York City, there's a lot of people employed by, the New York City government. So, again, it's how you want to look at it. The bottom line is you're not getting a rate cut in September. I really don't think so. I think just as a rule, they wouldn't want to do it before the election anyway. Not that it's going to have any impact, because it takes at least 6 months for it to do anything. And we say this every episode because we're always short for material. But, don't expect this to impact mortgage rates, too. The Fed has no control and no direct impact on mortgage rates. And unfortunately, mortgage rates rose last week for the first time since late May. We're on this nice string of over a month of rate declines, but they're still slightly below 7%. So that's something to be excited about. All right, we're going to take a break for this important message, and then Michael's going to give us everything we need to know about the housing market.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
And we're back with Michael Vargas.
Hello.
So you're an appraiser. I have a great leading question here. Since so many people ask economists difficult questions, about important things, let me ask.
Are you going to ask me how much your house is worth?
No, because I'm not looking to sell it, but we'll talk about that later. You never know. Mortgage rates are still high, right? They more than doubled over the last couple of years. Inventory is now, according to NAR, existing home sale inventory is 19% higher than a year ago. We talked about the economy slowing down. Consumers are running out of money. And the number of sales are down. How the heck is the median price of an existing home how did it just hit a record high of $419,300,000 under these circumstances? I don't know the answer you're going to give me, but I guess the question is, it's obviously about inventory, I'm assuming, but when does that change?
So that's a good question. There's so many parts to that question.
That's
Let me
right.
see if I can
ask good
unpack them
questions,
all.
see?
Yes, the volume of sales in so many regions has fallen, but that's not a sign of falling demand necessarily. It's more about the lack of inventory, and in a lot of places there's a chronic lack of inventory that we've seen for a number of years now. So I think that the demand for the housing is still there, and there's not enough listings to meet that demand, so that the available, the available product out there is going to still have, in many cases, more than one buyer for the property that's available. And so, you're still are going to see prices rising. So
Demand's still a lot stronger than supply.
That's right. So, I mean, there hasn't, the balance, when do we get to that balance? Inventory's got to go up another 10 or 15 or even 20%.
It's still under 4 months. I mean, if you look at new homes, a different story. New homes, the inventory is like double that. But
so I think, last year we still were seeing in a lot of markets, not Manhattan, which we can kind of, parcel out all the different markets, but we were seeing still rapidly appreciating prices because inventory was so low and demand was so strong. Now inventory has gone up, 15 or 19% according to that survey. So that's helped to kind of mitigate the price growth, but still not get to the level where you find a balance, where you find the market as neutral. So in just about every market, it's still at least a neutral market, and in most, it's a buyer's market.
Do we still consider a neutral market 5 to 6 months supply, or is it higher than that, or is it market specific? And just for people, I know we've mentioned this before, but one of the probably the best way to look at inventory is in relation to the pace of sales. So if you have 100 homes for sales and you're selling 10 a month, that's a 10-month supply. That's too high. If you're selling, 20 a month, then it's 5-month supply. It's a lot better. But do you think that has changed, or is that just always in that 5 to 6 month range is neutral?
Yeah, I think the neutral is still, from an inventory perspective, if you're in the 4 to 6 month range, that's neutral. But when I think about, the market and some markets getting to neutral, it's because the price appreciation has kind of slowed. So it's not that prices cannot, that a property can't sell for more than the comparable from 6 months ago. But it's, it's maybe not going over asking price, but maybe a little bit under asking price. So the pace of growth of price in some markets, inventory has gone up enough, or buyers are just too hesitant about the prices that they would have to pay. So that's kind of pulled back demand a little bit, pulled back the price appreciation a little bit. But that's only in a certain number of markets. I think in most markets you still are seeing, price appreciation, and you might expect another 5 or 10% increase unless we see another 15% growth in inventory.
Or, I mean, look, it makes sense that you have this job boom that's been going on, right? And an unemployment rate that stayed below 4% for a very long time, that's going to increase demand for housing. And even as rates went up, people getting job wage growth was pretty strong, but that's all changed now, right? You know, wages are still growing a little faster than prices, but not that much faster. Consumers are tapped out, $1.1 trillion in credit card debt. All the excess savings built up during COVID's gone for most people. It seems like, you know, the price growth does seem to be slowing in many areas. Like you said, you know, in a lot of places, time in the market is creeping up a little bit. You know, and we got a scary report recently on pending home sales. Pending home sales are when contracts are signed, not when closings happen. So they're really more about now, certainly a lot more about now than a lagging indicator like closings. They fell to a record low. And look, the NAR's been doing this only since 2001, but we've had a lot of cycles since 2001. Just anytime you hear record low, basically demand for housing, or at least activity, like I said, I agree the demand is there. People want to buy because rents aren't really coming down significantly either. I mean, do we just blow this off as it's going to be a couple months of painful adjustment, and then sellers are going to have to get a little more realistic because inventory will build? Is that the most likely scenario here, or do you see something else happening?
Yeah, I mean, I think with that pending sales report was probably somewhat of an anomaly, but it also could be an indication that, you know, that buyers have kind of reached their limit as to what's available out there and what it costs to pay, and at what price levels they see as either good value, a good deal, or affordable. And so it, you know, it might be a sign of things to come that, you know, more inventory on the market, buyers kind of hesitant about the prices, and they're not just going to continue to jump in and pay over asking price and bid against other buyers. And so you might start seeing kind of a leveling or a market that's moving more towards neutral. But I think, you know, from the seller side, you know, I think you still have this advantage where in a lot of markets where your competition has been so low and the number of available listings to compete with, especially in our areas, in our suburban areas, that, you know, everybody's been kind of aggressive with prices.
Yeah.
But you know, I think that, you know, it remains to be seen. But if that tide turns, it'll be because at some point buyers have kind of reached the limit as to how much they think they can afford to buy or to pay up.
Because rates are not going to move down noticeably for the rest of this year. We don't expect a lot to change there.
Yeah, because they need to, you know, probably get to 5.5% before that could change.
That's the magic number according to this survey, because people think that's the historical normal, which isn't even close. It's much higher than that. I think that it's hard for the frustration that home buyers feel. And this happens anytime markets overheat, right? Sellers get too aggressive, you know, this aspirational pricing or whatever you want to call it. I live in Long Island, still a pretty hot market, but my brother just sold his house. They were smart enough to price it well, and it went way over ask. Mm-hmm. The ones overpriced by him are not selling. They're sitting there for months. And then there's this standoff between buyers and sellers to see who flinches first. And I don't know what's going to push the buyers to go out there and buy aggressively now. I would think they would wait and see what changes. But
and I think that's right. You know, in a lot of markets for probably too long now, it's been kind of a game of seller name your price.
Right.
Put it on the market, you know, higher, 10% higher than the last comp, and you still have 5 people bidding on it. And so now it's going into contract at 15% over the last, you know, the comparable from 12 or 18 months ago. That's not really sustainable at some point, right?
Right. No, people always want to show that housing, you know, has a higher rate of return than the stock market. And I said it can't. Stock market returns about 7% a year historically. No one could afford housing if it went up that much every year. It's
No,
just
the
a lot more
long-term-
stability and utility than stocks.
The long term is really 2 or 3% growth. And so, but, I think at some point, though, it takes more listings, more inventory. It can continue in this direction if, mortgage rates came down and then the buyer all of a sudden felt like they had more purchasing power because they were paying, closer to 6% as opposed to closer to 7%. They would still be willing to pay up for a listing that's out there. But
it's kind of like retail sales in general or consumer spending. They're hanging on. They're finding ways to keep spending. They're getting less for their money because the rise in prices. And, look, the biggest component of inflation in the data in CPI is housing, shelter, as they call it. We're still using like pilgrim words. I don't know why we're still calling it shelter. But I want to ask this question. So over the last couple of years, basically since, I guess, about June 2020, a lot of these markets in the suburbs and most places that aren't New York City have had no inventory, and things are sold quickly, and prices have risen dramatically. How hard was it to appraise apartments or homes too when you have so few sales and you're chasing a moving target? By the time you even do the appraisal, the market could be up another couple percent.
Well, if you're the greatest appraiser of all time, it's not that hard. But for most,
I was going to make a joke. This is like the GOAT show here.
Yeah.
We got with the greatest economist.
The hardest part, it's interesting that if you lose 20 or 30% of sales data, that it could make a big difference in how difficult it is to find the data for the right comparisons in a particular market. It doesn't mean you have no data, but even carving out 20 or 30% of what we would normally have to choose for comparisons, it has been difficult. And then it's always the hardest in an appreciating market, as we have in a lot of these suburbs or areas outside of New York City. It is hard for an appraiser to keep up with an appreciating market. We use time of sale adjustments to say it's kind of like adjusting for inflation. We say, all right, this comparable sold for $1 million 6 months ago, and the market's up 5%. Then we can add a time of sale adjustment to that. But when people are bidding over ask at more than a normal pace of growth, it's hard for us to it's hard for an appraiser to keep up with a rapidly appreciating market. But for most of the market areas we've had,
if you can't keep up with it, how are the buyers supposed to keep up with it?
I mean, it's really the buyers determine the market, and we're trying to figure out where the buyers are fitting relative to the last 3 months or the last 6 months. Yeah. But really, they're setting the pace. They're setting the pace in the market. A property is usually worth what a buyer is willing to pay for it. And an appraisal will usually reflect that the meeting of the minds occurred between that buyer willing to pay what the seller, but there has to be, some logic, reasoning, or support for it for the last 3 or 6 months of data.
I want it. That's not enough.
Yeah.
Well, remember, it was Adam Smith that first said the value of anything is what somebody's willing to pay for it. Sounds like a simple concept, but it's true. All right, so let's look at some of the markets that we deal with in this area. New York City has been different because of inventory. Like, we have inventory. It seems so frustrating that every other place in the country, it seems, is desperate for inventory. We have enough here, but nobody's buying. That's what it feels like. It's not that bad, but Manhattan is up slightly year over year in sales, but you're comparing it to a terrible time a year ago. What are your thoughts on this? Why aren't we seeing more activity when the stock market's at record levels? Wall Street bonuses were $34 billion last year. The economy here has lagged in its recovery, but it's progressed. I mean, why is it the prices keeping everybody away? Because you would think interest rates wouldn't matter as much in Manhattan as they do in the outer boroughs.
Right.
What are your thoughts on it?
Yeah, I mean, I think as I may have said earlier, although if I got this switched, Ray, you can edit it out from earlier, but in almost
we only edit
every
out my mistakes.
yes.
We don't,
In almost every market that, we cover in this region, it's a seller's market, and it's been a seller's market for a while. Only in Manhattan do we find that it's a buyer's market. So what's going on in Manhattan? I think there's a couple of things going on. I think one is that, there's, half of the sales are co-ops, right? And half of those sales are aging co-ops. And even a lot of the condos that we're, seeing, resale condos, is aging housing product. And, the cost of upgrading these properties still remains high, even though, inflation seems to have gotten in check. And so it's just going to, naturally depress prices for this kind of aging and older housing stock.
I get asked this a lot, and you probably get asked a lot more than me. When we talk about unrenovated co-ops, people say, well, where is pricing now? And I don't like to generalize things in general, and say, well, we're back to 2016 or 7 or 15 or whatever it is. But what are you telling? I'm sure you get a lot of calls from agents wanting to know what comparables they should be looking at, and where are we, relatively speaking, as best you can. Because I've heard people tell me in some areas they're down to 2013 pricing, which seems a little scary to me. But what are you seeing in your appraisals?
I mean, no, I think that's right, because for the aging kind of housing stock of co-ops, there's also kind of a shift in, a generational shift in what people find appealing and in what they want to buy, that we haven't seen much of any growth for 10 years. And it's kind of I've been doing appraisals for 30 years now, and the first 10 years and the middle 10 years of that period, prices always increased. And in some cases they doubled from year 1 to year 10. This most recent 10-year period from 2013, 2014 to now is the first time that we've seen no appreciation in a lot of these older co-op assets.
When you were on a couple of months ago, we talked about how even during the worst of COVID, prices didn't really change here. And then in the boom of 21 and early 22, prices didn't change. Or is it so we can't look and say, well, prices are at the wrong level because they haven't been changing? Or are they just that slow to react that it's just going to take longer because I had Cale Goodman on a couple of weeks ago, and he talked about how co-ops should be benefiting because they're the cheaper product, all things being equal. I don't mean cheaper meaning not as good as, but the underlying mortgage, the rules that come with them, that they tend to do pretty well, relatively speaking, when the market is sluggish or prices are high, or because it's cheaper than buying a condo with more amenities. So why does it seem that that's not happening, or is it just so slow? Except for these ultra, we just had $117 million closing.
Well, going back to some of the things that I think are occurring in Manhattan. One is that I was mentioning that in the stock of housing, the co-ops and even some of the condos are just aged, and that the cost to upgrade them is high enough to mitigate some of the growth and potential value there, or at least for buyers to view these potential purchases as priced too high. And so, you're going back to that inventory is not particularly high in Manhattan. Sales volume is lower, but there's no price. There hasn't been any price growth in Manhattan as in other markets. Right. And I think part of that, what's holding that back, is just the cost to upgrade a lot of these units, but also that the asking prices are too high. And I think I've probably been mentioning this. I probably mentioned it the last time I was here. Is that there's nothing like a 10 or 15% price decrease to spur demand.
Right.
And so, you know, I think in this, maybe I was on Vince's show, but it was about.
I didn't give you permission to do Vince's
right.
show.
Sorry.
Right.
It was really, you know, my questions were about, you know, I was questioning what is it going to take in Manhattan specifically? What is it going to take to get buyers excited to jump back into the market so that we see an increase in contract activity and sales volume
down to 5.5%. That might do the
so
trick.
It's either going to be lower rates, a very strong hot economy with, you know, rising, you know, with jobs and people coming here for jobs and incomes growing, or that, you know, the dynamics of the market are for the seller side. The reality is that they can't, you know, they may not be able to get $1.5 million for the what they're asking, but maybe $1.3 million or $1.25 million. So in Manhattan, I think, you know, sellers are still hanging on to prices that are, you know, are not going to make buyers enthusiastic about them.
Well, and remember, what is this? This feels like 2019 all over again, you know, because you need a real recession to reset prices. And we went 10 years basically without one before COVID.
Right.
And you forget how terrible the market was in 18 and 19.
You make a good point about 2018 and 2019, because what was happening then were, again, a period of time when sellers were really fixed on the values they were getting in 2015, 2016, and 2017. Yeah. And they had not yet realized that by 2018 and 2019, they needed to be 10 or 15% lower.
Plus, too focused on what they paid, how much they put into it, and what they were looking for.
Yes.
3 things that do not matter to the buyer. That's all right.
So generally, we have been seeing, you know, especially for the older co-ops, that, you know, we've seen appraisals come in at values that are the same as 2012, 2013, 2014, unless somebody has, you know, spent, you know, considerable amount of renovation capital, which is within the last 1 to 5 years. Okay. So if you even if you renovated something 15 years ago, and you think that it's triple mint renovated, 15 years is now dated.
Right.
And so you're still looking at values that are going to be less than what someone paid or what someone had, or, you know, what someone saw as a value or a price in 2015, and maybe they added some renovation capital. They're going to come in with a loss.
So you mentioned, we keep pointing out Manhattan, but the other boroughs are doing a little bit better, right? Isn't that surprising, given that they'd be a lot more interest rate sensitive?
Yeah, and again, the other thing about, you know, about Manhattan and maybe some of the negative trends is that there's just this perception that, you know, Manhattan is not as safe and not as clean and not as, you know, well functioning as it used to be. And, you know, for whatever reason, if somebody says the city is getting more dangerous or there's more news about rising crime, you know, there's this perception that the city means Manhattan.
Right.
And that, you know, even if there's, you know, obviously there's crime in the other boroughs, but it just feels like, oh, the city's getting, you know, less safe. I should, you know, there's this perception that it's all about just Manhattan. So you don't see, you know, so you don't see kind of falling demand in Brooklyn or in Queens.
I think that's also because Manhattan, you know, there are 1 million people that work in offices in Manhattan, people that commute like I do from Long Island, and are noticing the things that they've seen that they haven't really seen since, you know, the late 80s, early 90s.
Yeah.
And, you know, I think that there has been some things lately that just make you scratch your head, like the pause on congestion pricing. You know, we could just change our mind at the last minute. And then the MTA, which has no money to begin with, has spent all this money putting these readers up, including ones right by our headquarters at 770.
And I think that's a good point, is that I think, you know, as they're saying, it seems to be like this perception that the quality of life is, you know, diminished in Manhattan. And so people are still looking at, you know, anything, the boroughs or the close suburbs as the better option.
Well, I think also, I don't do inventory reports for all the other boroughs, but their inventory is not at the level that Manhattan's is, because a lot of the areas that we talk about in Brooklyn and Queens, you know, they started selling with the rest of the country in June of 2020. Things started flying off the shelf there.
Yeah.
And these neighborhoods have developed. All right, now let's go to the Hamptons. The story out there that I hear from our people is that there's just not enough for sale, and obviously there's still demand for that, and mortgage rates don't really play a part in the purchases. So what are you seeing out there? Is it still that slow because of the lack of inventory, or are people thinking twice because it is a heavily secondary market?
Yeah, I mean, I think it's certainly not as strong as the post-COVID years.
Remember those years?
Remember those years.
Nice.
And I mean, you mentioned, I'm sure it's not a mortgage rate sensitive environment, except that, at a time you could get a second home mortgage for 3%. That made a big difference as to, how many people were heading out east. And I think, there's certainly not a glut of inventory, but I think that market is similar to others, which are, on the higher end, which is that the seller is not just naming a price and then getting people to, come. And so there is inventory out there, particularly on the high end, which is not flying off the shelves.
Right.
So that's kind of maybe reached a point where the buyers out there are saying, those prices are a little too crazy. I don't see value in that.
Well, I could see that, but you look at the stock market; they do have a lot of money. You know, that's the thing, and it, rich people don't need mortgages, but if I could finance for 3%, knowing the stock market usually gets about 6-7% a year,
that was a no-brainer. So
that's why people aren't selling their homes now, because they have a 3% mortgage. They don't want a 7% mortgage, right? All right, so Connecticut, especially Fairfield County, has showed obviously a dramatic still, like they can name all the homes for sale in some of these towns.
I think in all of those kind of affluent suburbs, Connecticut, Fairfield County, and Westchester,
Jersey too.
Jersey, we have Bergen and Hudson. Hudson's more kind of an urban environment. Essex, those suburbs, it's all the same story. It's a chronically low inventory, and falling but still sufficient demand, translating to higher prices.
Right.
And that seems to be sustainable in the short term. But again, at some point, the prices will reach a point where there's hesitation on the part of the buyers, and then you'll see some retreating on prices.
And I like to remind people, I bought my house in 2006. I couldn't have picked the worst time to buy it. Brilliant economist that I am. But when your wife likes the house, you buy the house. I've learned that.
Well, I think the other thing
I bought it. I've refinanced 3 times since my original 6.5% rate.
But also, and I think a big thing that's happened in this particular cycle with all of these suburban markets and markets just outside of Manhattan, like Hoboken and Jersey City, is the new dynamic about how people work, right. And not being forced to come back to the office 5 days a week.
All these threats we've been hearing
right.
for the last couple of years. You have to come back. And
so if you feel like the city is not the same as it used to be, and you don't need to commute anymore to work,
all of a sudden you can live a little
further. You start saying, how far does my $5 go? Markets where, I think the lack of commuting is a big thing, because you can go even further out.
As someone who's been doing it for 32 years, the lack of a commute helps.
The lack of commute makes a big difference in terms of people wanting to find a place to nest and have a home in a particular area. If the concern is not always getting on a train for 5 days a week for 2 hours a day, there's more focus on what's available out there, what can I buy,
right.
And it, as you said, it's a long-term thing. So even if you're looking at prices that are higher than ever, you're not, I don't think buyers are concerned yet that they're, are they paying too much?
Right.
And is this going to be worth less? Are they paying at the peak? There doesn't seem to be any concern about that.
Well, I think the concern is still the fear of missing out and
Yeah.
what that does to people that lose a bidding war. Now, finish up with Florida. We keep reading that Florida is not seeing the volume. Obviously, inventory in some places like Palm Beach is chronically low. But, there are concerns there with homeowners insurance. And I got this in Long Island. I had to go through 2 different insurance brokers to get a new insurance plan because I live, a couple of blocks from a flood zone. And they tell me it's not the flooding, it's the wind damage like that from these storms. But we've seen some pretty impressive sales in Palm Beach. And what are you seeing going on in Palm Beach and Miami? Have you seen any marked slowdown in there? Or
no, not really.
The insurance issue, because we see there's stories too. The more and more people are not getting homeowners insurance. I guess if you don't have a mortgage, you don't need one. You see that impacting either of those markets there?
Well, in Palm Beach Island itself, no. There's, that's just a trophy market, and there still seems to be enough people out there looking to make a trophy purchase at whatever the number is going to take. I think this quarter will have recorded, or this just completed quarter will have recorded a sale of like 180 million, I think. So that's kind of going to skew all of the Palm Beach Island numbers, right?
That's why I'm glad I don't do those reports anymore.
It's going to be like
Palm Beach.
We're probably going to analyze 24 sales versus maybe 30 from last year, but that $180 million sale is going to kind of wreak havoc on the statistics.
Well, that's why people like the median price, but even the median price in such a small market is going to be impacted by that.
In some of the other markets, though, I think I started seeing this last quarter, around West Palm Beach and some of the other, more kind of middle of the market out there. I think you're starting to see the concern on the part of buyers about overall costs. Of course, mortgage rates high, so your costs are going to be higher, and then either higher insurance costs or not even being able to find insurance. I think that's starting to...
It's downright frightening for me. It's like, okay, I want to get rid of this company that I've been with for all these years because I thought they were price gouging. And then you go, now you know why they can do it. And then some company I'd never heard of, but apparently is well respected, came in and saved the day. But it's scary almost, because then does your house almost become unsellable? Because Long Island isn't Palm Beach. A lot of these other areas aren't where people are going to pay it.
Yeah, so I think there's those kind of calculations in some of the areas in Florida outside Palm Beach Island. I think the overall costs are beginning to weigh on buyers. So I think you'll start seeing, a leveling off and a stabilization in terms of values and prices, and maybe some correction, in the 5 to 10% range in some of those market areas, because buyers in those areas maybe have reached kind of a limit as to what they see as affordable or a good value to buy.
So I have one more question, because I get asked this a lot. Thank God it only happens every 4 years. Elections and housing markets. Do you see any real impact then? And I've said my thoughts on the show numerous times, but I'd love to hear your thought on, does it move values? Does it really impact activity? Is there this pent-up demand that's going to be unleashed in late November? What do you think?
No, I don't think it makes a big difference. I think that people have largely resigned themselves to things, not changing all that much one way or the other.
Government, right? It's like, let's have them doing a lot of nothing. Yeah. That's what Wall Street likes. That's
so there's kind of it's almost like a stagnant status quo, and so that it almost doesn't make a difference. I think it still all boils down to, someone's own personal economy in terms of how they view their job prospects and their income, and what they can afford to buy. So everybody needs to live somewhere. It doesn't matter who gets elected. You either have to rent, buy, or live with your parents, right? And so, it's just all about a question of the strength of the economy and about jobs more than anything else.
Well, and both these people running have been president. So it's not the complete unknown that it was in 2016.
Yeah.
And I always point out these things don't happen in vacuums. 2020, COVID was raging. We've had it after terrorist attacks. Right before terrorist attacks during a recession. We've had it after the financial crisis. These things, a lot can change in a span that have nothing to do with who the president is necessarily. I think obviously everything is so ramped up now. Everybody's too angry. Why can't we just come on and get happy? We were talking about the Partridge Family earlier, me and Ray, because I'm doing a set with my niece and my nephew and my son on Sunday, and we just. What did you say? Oh, who are the Osmonds? I said, no, we're the Partridge Family, but we just don't have the Technicolor bus, right? That was an awesome bus, and we need a Reuben to make fun of all the time. But thank you for coming on the show.
Always a pleasure. Always a pleasure.
We've known each other almost 21 years now. In October, it'll be 21 years.
Oh, wow. How about that?
I
Time
know.
flies.
It seems like yesterday.
Time flies.
I haven't asked you about this, though, but are you excited about your New York Giants' upcoming season?
Not really.
No, you shouldn't be. You're in a terrible position. Look, we're betting, the entire future of the New York Jets on Aaron Rodgers not getting another season-ending injury. Outside of that, our roster is pretty amazing, I think. But again, it's a bunch of old, oft-injured offensive linemen and a 40-year-old quarterback and a terrible offensive coordinator, and we're betting a whole season on that. Now that the Yankees are not getting it done, the Rangers let us down, the Knicks were bit by injuries.
Let's go Mets.
No, not going to happen. Well, that's our show for this week. Thanks again to Michael. Thanks to Ray and Lena for the work they do behind the scenes each week. And most importantly, thanks to all you subscribers and viewers and listeners out there. Again, we've been more successful than we ever thought, and we owe that all to you. So thanks, and have a great week.